Howdy mate, welcome back to Matt Brown 360. I'm Matt Brown and I'm here to reveal a 360-degree view of your personal financial mastery and the creation of success in your life. This video is going to explain what assets are and how to think about investment portfolio construction through asset allocation. At the end of this video, find out how you can access a premium asset allocation tool that assesses your personal risk tolerance. How emotionally comfortable are you with taking financial risk? How often have you taken financial risks before? It's very interesting. And if you stay right to the end, I'll give you my core portfolio asset allocation. See you soon. Firstly, let's kick this off by defining what an asset is. An asset is anything of value that can be converted into cash. It is something containing economic value or a potential future benefit. Assets often generate cash flow, currently and future cash flows, such as a financial security like cash or term deposit into a bank account, or a piece of machinery used in a factory to make something, or a patent or software application code. No investment into any asset is risk-free. Even cash is risky. When inflation is allowed to increase too rapidly, our purchasing power diminishes significantly. Our purchasing power is the real value of money, or to be more specific, the value of our currency, the Aussie dollars. What we can exchange our hard-earned currency for in terms of goods and services. We need to be able to think about our money not in terms of cash, but as the Aussie dollar and what the Aussie dollar buys us. On January 1st, 2011, the Aussie dollar closed against the US dollar at $1.02. Then continued to rise up to $1.10 on the 28th of July of the same year, 2011. This was the golden times of online shopping for Aussies. We could shop at international websites, and already cheap prices were cheaper once we converted our Aussie buckaroos into US dollars, English pounds, or even the euro. I hope you all took advantage of the overseas travel at this time, or at least converted some Aussie dollars into the US greenback for future traveling expenses. Not that we need to worry much about traveling overseas at the moment, as we can't even travel outside of our home states, let alone overseas. Our land down under is experiencing the global virus crisis like the rest of the world. At the onset of this crisis, the Aussie dollar fell to a staggering low of 57 cents. That's nearly a 50% drop in our currency's purchasing power. Foreign exchange risk can totally wipe out investment gains if you are not careful, or even worse, turn a great investment that has appreciated in value into a loss once you convert that foreign gain back into Aussie dollars. Our world has never been more interconnected, and holding currency is risky. Investing in assets in foreign currencies can be even riskier. But once you know what you are doing, you can lower your risk by utilizing currency hedging tools. Do not try this without seeking professional advice if you are a novice or intermediate investor. This is a general advice like the rest of this video. As you know, I'm a licensed financial advisor, and nothing I am explaining in this video should be implemented without consulting a professional. I don't know your personal circumstances, so this is not personal advice. I repeat, this is not personal advice. Before implementing anything that I've spoken about in this video, please complete your own independent research, then seek professional paid advice. There is a full disclaimer in the show notes below. Whew. Now that we got that out of the way, let's move on to some other assets and where they fit into our asset allocation. So what is asset allocation? Asset allocation is divided into two primary sections. We have growth assets and we have defensive assets. Growth assets are designed to grow your investment capital over time. They include investments such as shares, property, and alternative investments. Growth asset capital can increase or decrease depending on the underlying asset's current or predicted future performance, or a global or local market volatility. Growth assets should provide investment returns in the form of both capital appreciation and income throughout the investment timeframe. Defensive assets, on the other hand, are designed to preserve capital historically. They tend to carry lower risk levels and more likely generate lower levels of return. Generally, defensive assets are only expected to return or achieve an income return for you. Well, who doesn't love talking about growth assets? Aussie barbecues are filled with talk of wonderful, profitable property and share investments, stories, tips, and winners. In my 40 years, not a single person has ever asked me about the best bond investment I've made. Actually, from memory, I can't even think of one right now. But with that being said, I do remember a time when the best yielding bond investments I've had the opportunity to invest into were post-GFC, around 2010, 2013, when the banks were raising capital. Some of these bond investments were paying an 8 to 10% annual coupon rate for a 3 to 4 period. Now, that was a good return on bonds. But back to growth. Shares, as most of us understand them, are units of ownership in a company. The company can either be a publicly listed, like CBA on the ASX, or Apple on the NASDAQ, or any company that is listed on a public exchange worldwide. These companies are bought and sold millions of times a day by both institutional and retail investors. We're retail investors. Institutional investors are money managers. To purchase publicly listed shares, you need to have a brokerage account or a stockbroker. There are also private companies that don't need to follow all the rules, regulations, and reporting of listed companies, but owning shares in them is very similar. You should have voting rights and income distribution rights, but you need to be more diligent when purchasing shares in these companies because they might have different classes of shares with different entitlements. Always review the company constitution as part of your research due diligence. Purchasing these shares are usually done through private legal contracts of sale and should be accompanied by a shareholders agreement. Property. Oh, where do we start? I love property the most of all asset classes, but believe in building a balanced, diversified portfolio over time. We have lived in a property either with our parents, renting, or when we purchased our very first home. I've done them all. Property can be a residential house and land, a unit, a commercial property including office space, industrial, multifamily, and retail shops. There are different ways you can access this asset class. You can buy a residential property, house or unit, then rent it out to a tenant. You can buy commercial property and then rent it out to a business. Or you can access larger commercial investments of diversified REITs. A REIT is a real estate investment trust run by an investment manager for fees and can provide good diversified access into the commercial property area. You can now also buy a fragment of property on the Bricklet platform. Your name is on title and the property investment is completely passive like equities, meaning no calls from the managing agent ever. Bricklet has created a property investment ecosystem that allows you to build a diversified portfolio of investment property that is completely managed on your behalf. Currently, the ongoing fees for this is about 4%. They enable each individual to leverage into the investment opportunity. Obviously, lending criteria applies, so you can borrow money to invest on the Bricklet platform. To be totally transparent, I need to let you know I have an interest in Lakiba, the parent company of Bricklet, and my business partners and I are early stage investors in Bricklet alongside Mirvac and Stockland. When I saw the big boys put their hands in their pocket, investing into this new innovative platform, it confirmed that Bricklet was here to stay and they were going to shake things up in the property investment marketplace. All in all, I think this platform is going to revolutionize the way Aussies build property investment portfolios. Now, for alternatives and derivatives. I'm not going to explain all the alternatives and all the derivatives in this video. It would simply be too long. But if you'd like me to expand on anything in particular, please comment below and hit that like and subscribe button and you'll be updated on all the new videos that I bring out weekly. Commodities. Think gold, silver, oil, coal, options, call options and put options. Futures is an agreement between a buyer and seller to buy something today for a certain price that is going to be delivered in the future. Cryptocurrency, think Bitcoin, Ethereum, and the other 1,600 that are out there. Licenses and patents. Microsoft and Google license their intellectual property to businesses and us, individuals, through their 365 and Google Docs platforms for monthly fees. Build a private company. The wealthiest people in the world have typically done that through investment or building businesses. Alternatives are included in a portfolio to create diversification away from historical growth and defensive asset classes. They typically are uncorrelated to financial markets. The simplest example of this is gold and silver. These precious metals have an inverse correlation to equity markets. When equity markets rise, gold is stable or declining in price. And when there is a stock market correction or crash, gold and silver rise, as these precious metals are seen as a safe haven where there is increased volatility in growth assets. Seeing gold hit all-time highs alongside the S&P 500 and the NASDAQ 100, which has all occurred very recently, is a very interesting phenomenon. The last time this happened was back in 1979. Keep an eye on this space. A hedge fund investment can be a terrific, uncorrelated investment if you can access them. These investment managers create profits when markets go up, when they go down, when they go sideways, by hedging their investments and using leveraged derivatives. Hedge funds usually only accept capital from sophisticated investors, and they have minimum capital investments in the millions of dollars. Like I mentioned, if you can access them. Don't feel left out of the cool club, I'm not in there either. As I mentioned previously, defensive assets are included in the portfolio and are designed to protect capital and provide an income stream throughout the investment time frame. But down under, we can't access bonds directly as retail investors. We can only access them through ETFs and managed funds. Bonds are debt securities issued by corporations, governments, and other organizations and sold to investors. Governments and large corporations don't go down to the bank to raise capital. They use bonds. A bond is a debt instrument. When a company needs funds for any number of reasons, they may issue a bond to finance that loan, much like a home mortgage. The issuer creates each bond with a face value, for example, $1,000, a coupon rate of 8%, and a fixed repayment time frame of 5 years. If you invested into this bond, you would receive $400 in coupon payments over the 5-year period, and then the initial capital of $1,000 would be returned back to you at that 5-year maturity. Bonds are now traded daily by fund managers. This means that each bond within the fund is repriced daily, and our defensive portfolio's capital now fluctuates with local and global interest rate movements. Not that defensive anymore. With technology, the emergence of peer-to-peer lending has enabled investors to become the bank and make small loans or participate by investing in a fragment of a loan. All different types of security is available, but this is usually property, either residential or commercial. The borrower needs, for example, $100,000 for a 3-year period, and they're willing to pay 7%. The loan interest is usually paid on an annual basis in advance or monthly in arrears, with the loan being 100% repaid at the end of the term. The loan to value ratios in these types of investments is also quite low. You're looking for things that are below 70%, but better still below 60% loan to value ratio. This type of investing will become a lot more popular in the future as investors starved of income look for alternatives other than equities to generate that ongoing income stream for themselves. Thank you for staying to the end of this video. I hope you enjoyed it. Please hit the like and subscribe button below. To access a complimentary risk tolerance questionnaire and report, along with investor profiler, both delivered through the world-leading Phinemetrica, hit the link here or the show notes there. I both pointed down. The core portfolio asset allocation, as promised, is 70% growth and 30% defensive assets. That's it for me today. See you next week. Just joking. The breakdown of the defensive assets is 10% at call cash, 20% in peer-to-peer lending and bonds. The breakdown of the growth portfolio is 15% commodities, primarily gold, 30% property, and 25% equities. I rebalance this portfolio once a year. This is a core portfolio, mostly of ETFs, that is surrounded by satellite direct equity investments. Have a great day and live a rich life.